Right, let's continue our conversation now. Joining us, John Sedunov, Associate Professor of Finance at Villanova University. So obviously today we're going to be seeing a lot of finger pointing here, but should regulators have really foreseen these bank collapses?
Hi there. Well, thanks for having me. Regulators probably should have seen this coming. When you look at annual filings, quarterly filings from the bank, the interest rate risk on the balance sheet was apparent. And the fact that the institution didn't hedge this risk also should have been apparent. So, it's a little bit concerning that regulators probably observed these things and chose not to act, or at least from what we can gather, chose not to act. And it will be interesting to see how it plays out here to understand better what they did or did not do as they observed these things unfold in the months before the failure of the bank.
And as you mentioned, that months before the failure, we already knew that interest rates were rising, that there was a disproportionate interest rate risk to these particular banks. Then in terms of some of the existing legislation that's out there, could anything have prevented this?
It's not necessarily clear that it totally would have. I think if you think about things like capital requirements that are oftentimes things that we care a lot about, think about liquidity ratios that banks are subject to dealing with, likely SVB would have been fine along these lines. When you start to build in then the fact that they have losses on the held to maturity portfolio that they weren't expecting to have to sell away, but eventually you have these depositors who are fleeing the bank that force them to take losses in that area. These losses become apparent. The weaknesses become a little bit more apparent. But at its face, when you think about the stress testing that the bank would have had to deal with, capital requirements, liquidity ratios, likely, again, mostly fine as far as the headline stuff. So you kind of probably need to dig in a little deeper than just the top line items to really understand the bank's situation.
And we know that there have been a lot of comparisons to 2008. And you said this isn't the same sort of systemic risk. This disproportionate exposure that Signature and SVB had really does differentiate it. But when you look at some of the factors that led up to it, what sort of reforms could really affect this? We saw the reforms that happened after 2008. What would really help in this situation?
Right. And when we think about reforms, when we think about regulation that happens after a crisis, it's typically we're fighting the last fire and not always looking forward to the next one. So after 2008, it's all about liquidity and capital requirements. Stress testing becomes a big deal. Now, I think you have to start to think about a little harder about liquidity ratios as it relates to the bank's deposit base. Banks that have less stable funding, banks that have deposits that are more likely to be, coming and going from corporations, less sticky. When you have those kinds of situations, you have to think harder about what the liquidity rules are going to tell you and to be prepared for a potential outflow of deposits. From the interest rate risk side, it's a little less clear to me because, again, when you think about interest rate risk, this is a textbook thing that banks should be able to manage, and most banks do manage. And so, there can be checks and guardrails as far as increased scrutiny of banks' hedging practices as it relates to interest rate risk. But at the outset, this is something that should have been done in the first place.
And John, I also want to ask you about the aftermath. Now, we know that the deposit insurance fund, that's pre-funded, that banks pay into this. But a lot of people wondering why the OLA, the Orderly Liquidation Authority that comes under Dodd-Frank, why that wasn't used instead of the Fed sort of essentially just backstopping these banks?
I think that's a good question. But when you bring in the Fed and when you think about the potential for a larger scale situation, having the Fed come in to backstop institutions and other regulators serving in similar capacities, I think the idea here is to stop the bleeding and to give a signal of strength in the financial system. I don't view Silicon Valley Bank or Signature Bank as a bank that's interconnected, that their risk and their spillover of their risk is going to cause others to fail directly, like maybe you would have had in 2008, like we mentioned before. But panic can be contagious. Even if other banks are fundamentally very sound and very healthy, panic can be contagious, and panic doesn't need a fundamental reason. And so when you have the Fed step in as a backstop, when you have the FDIC guaranteeing non-insured deposits, it's all there to help solidify the banking system, to give confidence to depositors and keep things as stable as possible. And so far, it seems generally that's been working. It's not out of the possibility that we see another bank fail. I don't, though, foresee widespread contagion and multiple banks failing. And in part, that's due to the role of the regulators and what they have done to kind of backstop the system.
And you mentioned it's more so the panic that had the systemic reaction versus the actual banks themselves. Is there anything you think that lawmakers will say today that will really solidify some confidence in the banking sector when you really do have some of this panic that's still making its way through the system?
That's a good question, and it's really hard to say because I think what we're going to see in the hearing here is actually stuff that could potentially make people a little bit more uneasy as you're kind of going through why all this happened and exposing some shortfalls in the system. I think regulators have to be careful about what they say, and we saw Janet Yellen make comments that were somewhat at odds with themselves over the past few weeks about who's going to be bailed out, what depositors and what banks would or would not be. And in some cases, I think those comments eroded a little bit of trust in medium or regional banks, even smaller banks, and led to more of a deposit flight to larger institutions. So regulators really do have to be careful about what they say as a result of this crisis. And again, what you say contributes to panic or lack thereof. And so it's paramount that they are careful about what the message is at the end of the day.
Indeed, we know people will be passing through the testimony that we hear today. John Sedunov, thank you so much. Associate Professor of Finance at Villanova University. Thank you for your time this morning.